December 2025 marked a seismic shift in global finance, hidden in plain sight while most were preoccupied with holiday shopping. Dubbed the trillion-dollar shuffle, over $1 trillion moved across financial markets within weeks. The world's largest money managers, Vanguard, BlackRock, State Street, CalPERS, Norway's sovereign wealth fund, and Japan's government pension system, acted in unison, selling off winning positions, stockpiling bonds, and shifting their strategies to a defensive stance. Media narratives dismissed the event as routine year-end portfolio adjustments, but the truth runs deeper. This wasn't routine housekeeping. It was a warning, a significant signal of impending turmoil. Fast forward to January 2026. The United States national debt has surged to $38.4 trillion, up $2.25 trillion in just 1 year, an unnerving pace of $8 billion added daily, including weekends and holidays. Interest payments alone have reached a staggering $1 trillion annually, making them the second largest government expense after Social Security. These aren't principal reductions. They're just interest payments. This burden now eclipses spending for defense, Medicare, and everything else except Social Security. Vanguard, overseeing $11 trillion in assets, has upended its traditional investment guidance. For decades, the 60-40 split between stocks and bonds was a cornerstone of conservative investing, but now they advocate for a 40-60 allocation, less exposure to stocks, more reliance on bonds. Vanguard AS chief economist described this transition as a tectonic shift, not a subtle adjustment, but a major realignment focused on survival rather than profits. Institutional investors followed suit during December 2025, unloading more than $1 trillion worth of assets. This included tech companies from the so-called Magnificent Seven, NVIDIA, Microsoft, Apple, Amazon, leaders of the AI-driven economy that were once seen as invincible. These sales weren't driven by deteriorating fundamentals or failing business models. They reflected escalating valuations and amplified risks. When systems face catastrophic breakdowns, only defensive assets retain value. This is not mere speculation or guesswork. It's pattern recognition grounded in history. Every significant financial framework, empire, or government that attempts to outspend fiscal realities follows the same inevitable trajectory. The historical blueprint is divided into 4 distinct stages. Stage 1 begins with stability, a foundation based on sound money supported by tangible values like gold or silver. Governments collect what they spend, and citizens retain trust in the currency, fostering economic growth. This phase is marked by balanced trade and price stability fueled by an appropriately managed money supply aligned with real economic output. Stage 2 introduces expansion and debasement, the consequence of governments overreaching their financial means. Wars, infrastructure ambitions, social plans, and crises demand unsustainable levels of spending. Taxation alone cannot cover the shortfall as populations resist higher rates. But the promises must be honored, obligations met, so governments resort to currency debasement, a deceptive solution to create purchasing power from nothing. Initially, the changes are subtle, slightly diminished precious metal content in coins or marginally increased money supply. It seems temporary and barely noticeable. The currency looks the same. Life proceeds without disruption. Yet, this marks a critical turning point. The government's monetary strategy shifts from creating value to manufacturing illusionary power. At this stage, constraints lift and promises expand uninhibited, but at severe long-term costs. Upon discovery, this power becomes impossible to resist. Stage 3 marks the onset of crisis and loss of control. The pace of debasement quickens. What initially began as 5% rises to 10%, then 20%, eventually 50%. The government's demand for more resources grows in parallel with its need to fund additional promises and address the growing crises created by earlier debasements. Prices begin to climb, subtly at first, but soon exponentially. Ordinary citizens feel the sting as their purchasing power diminishes. Merchants start rejecting the devalued currency or insist on larger amounts of it for transactions. In response, the government doubles down, printing even more money, deepening the debasement, and hastening the downward spiral. Trust begins to evaporate. People scramble to secure tangible assets, land, commodities, gold, anything with intrinsic value untethered from governmental assurances. The velocity of money surges as everyone races to unload the depreciating currency before its worth sinks further. To regain a semblance of control, the government imposes price controls, freezes wages, enforces mandatory acceptance laws, and institutes capital controls. Yet these measures fail. The currency devolves into an object of scorn, a liability to be offloaded promptly. Amid this chaos, the social contract crumbles and faith in institutions erodes. This tipping point signals a dangerous trajectory. The path becomes irreversible. Stage 4 dawns with its inevitable conclusion: total systemic collapse. Hyperinflation runs rampant, or the currency is abandoned outright. Trade collapses into a barter economy. The government, crippled financially, loses its ability to perform even basic functions. Social structures decay. Those who anticipated this and safeguarded their wealth and real assets endure the upheaval. Those who naively trusted government promises lose everything. In time, a new system arises, commonly anchored by sound monetary principles. The cycle resets itself, only for history to repeat when the memory of collapse fades over generations. This is not conjecture or personal opinion. This is immutable historical fact. Let's examine it through evidence. In the 2nd century AD, the Roman Empire presided over vast territories, from Western Europe to parts of North Africa and the Middle East. 2 centuries of dominance saw Rome ruling over 65 million people, about 20% of the world's population at the time. The denarius, a coin comprised of 4.5 grams of pure silver, was the global reserve currency trusted across lands stretching from Britain to Mesopotamia. Its unwavering purity underpinned centuries of thriving trade, vibrant commerce across continents, and expansive infrastructure projects such as aqueducts, cities, and enduring roads. This was stage 1 in full effect, a system functioning near flawlessly. But empires are expensive endeavors. Maintaining Rome's extensive borders required vast resources, armies, fortifications, administrative oversight, all while demands for social expenditures like grain doles and spectacles continued rising. Under Emperor Nero in 64 AD, a pivotal decision was made. The silver content in the denarius was reduced from 100% to 93%. It seemed minor at the time, a temporary fix at best. Yet successive emperors followed suit, each devaluing it further. By the reign of Marcus Aurelius, the denarius contained only 75% silver, marking visible cracks in Rome's foundation. Don't take this on faith, investigate for yourself. Credible sources back this progression: U.S. Treasury data, congressional reports, Federal Reserve figures, all meticulously documented and readily available in linked materials. Review the data weekly and watch how these figures climb in real time. Once observed firsthand, their implications are hard to ignore. This perspective is why discerning economic actors are repositioning themselves now. By the 3rd century AD, an era historians dub the crisis of the 3rd century, Rome's monetary decay accelerated dramatically. The Antoninianus replaced the denarius, purportedly valued at twice its predecessor, but weighing only 1.5 times more. By 250 AD, coins contained just 5% silver, their bronze cores merely coated with a thin silver exterior that quickly wore away, a blatant symbol of monetary fraud. Price inflation surged catastrophically. What once cost 1 denarius skyrocketed to 50, then 100, then several hundred. Soldiers demanded escalating wages to offset their declining purchasing power. The government churned out even more debased coins to placate them, intensifying its feedback loop of inflation. In a desperate attempt for control in 301 AD, Emperor Diocletian issued an edict on maximum prices to cap over 1,000 products and services under penalty of death, including execution for charging too much for basic goods like bread. These measures failed spectacularly. Merchants ceased trading altogether while black markets flourished out of necessity. Eventually, barter supplanted currency as trust in money disintegrated entirely. The Western Roman Empire succumbed to a fatal decline, staggering onward for 2 more centuries until its eventual collapse in 476 AD. A clear and repetitive pattern emerges. 4 stages play out, each entirely predictable. Fast forward to November 1918. World War I ends with Germany's defeat. The Treaty of Versailles imposes crushing conditions, territorial losses, strict military limitations, and 132 billion gold marks in reparations, an unpayable sum meant to cripple Germany for generations. This weight falls on the nascent Weimar Republic, a fragile democracy struggling to govern a devastated nation saddled with insurmountable debt. Pre-war Germany had a robust economic foundation, with its currency, the gold mark, widely trusted and stable, reflecting the nation's industrial prowess. That was stage 1. But with reparations looming, tax revenues fell far short. The German populace, exhausted and impoverished, couldn't bear higher taxes, yet the punishment payments had to be made to stave off foreign occupation. Thus began the government's descent into excessive money printing. What started subtly soon snowballed. The mark's value halved repeatedly. 4 marks per dollar became 8, then 16. In 1922, Germany defaulted on repayment. In response, France and Belgium occupied the Ruhr Valley, the industrial heart of the nation. To counter this occupation, the government encouraged passive resistance and strikes. But there was no productivity, no revenue, only workers demanding wages. The solution? Escalate the printing of money. Printing presses ran nonstop as monetary debasement entered a runaway spiral. By January 1923, a loaf of bread cost 250 marks. By November, that same loaf cost an unimaginable 200 billion marks. People hauled wheelbarrows of near-worthless cash just to buy groceries, and wages were demanded twice daily to outrun hyperinflation. The fallout was catastrophic. Savings vaporized overnight, the middle class was decimated, and pensioners starved. The economy crumbled under the weight of exponential currency devaluation. Society fractured. Political extremism thrived as disillusionment deepened, setting the stage for Adolf Hitler's rise just a decade later. By November 1923, the mark's exchange rate soared to an astronomical 4 trillion per dollar, rendering it effectively worthless. The government abandoned the mark entirely, replacing it with the Rentenmark backed by land mortgages. This ended hyperinflation, but left lasting scars. The wealth of an entire generation had been wiped out, and trust in democracy irreparably eroded. The conditions for fascism were now firmly set. The sequence was clear, a repeated pattern of collapse and ruin. Rewind to the early 1600s during the 30 Years' War. A different time, but uncannily similar circumstances. European treasuries bled dry as war expenditures mounted. Within the Holy Roman Empire, German princes grappled with a collapsed tax base as their peasantries slumped into poverty. Before this crisis, the empire's silver coins, reliable and consistent in weight and purity, were central to trade across Europe. That was stage one. But war feeds on funds. Seeking quick fixes, the princes turned to debasement, manipulating their coinage by diluting silver with cheaper metals. A few adulterated coins became many more in circulation, a tempting illusion of sudden wealth creation. Yet the practice snowballed. As soon as one ruler debased their coins aggressively, others followed suit to stay competitive in what became a race to debase further. By 1622, it was impossible to ignore reality. Coins lost their uniformity. Once trusted pieces became inconsistent in weight and value, some reduced to nearly worthless copper. Prices skyrocketed. Merchants rejected payments or demanded multiples of the old prices. Trade across borders ground to a halt as distrust spread like wildfire. The monetary system disintegrated. By 1623, the crumbling system forced reform. The empire compelled German princes to cease debasement and issued new currency, but not without devastating consequences for those who had held on to old coins. Generations of wealth were obliterated, entire economies reset at significant losses, leaving nations to rebuild from nothing. The lesson seemed clear for a time, but within a generation or two, memory faded and temptation reemerged. Yet again, the cycle repeated itself. 3 distinct examples: Rome's fall, Germany's inflation-blighted republic, and the Holy Roman Empire's debasement fiasco all tell the same story. Predictable stages of failure that lead inevitably toward collapse. Each time driven by unsustainable fiscal policies that erode trust and stability. The pattern is undeniable. Now consider this same framework applied to modern times, to America, the global financial system, to what is unfolding right now as you're reading these words. America's economic trajectory took a pivotal turn in 1971 when President Nixon ended the gold standard by closing the gold window. From that moment forward, the US dollar ceased to be tied to any tangible asset, transforming into a fiat currency. Value derived purely from faith, effectively a promise, or IOU. This marked the first time a global reserve currency held no intrinsic value. Yet, it functioned because the global community collectively accepted its worth, backed by the dominance of the US economy and the lack of viable alternatives. Since then, the pattern has been clear. Spend more than earned, print money to bridge the gap, expand the monetary base, and increase national debt. Repeatedly. In 1971, the national debt stood at $398 billion. Today, it has skyrocketed to $38.4 trillion, a staggering 95-fold increase, equating to a 9,500% expansion over 54 years. The pace of this debt accumulation is now unprecedented. It rose from $34 trillion in January 2024 to $35 trillion by July of the same year. By November, it hit $36 trillion, then $37 trillion by August 2025, followed by $38 trillion in October 2025. Essentially $1 trillion added every 5 months. This rapid growth in debt is notable for taking place in a period of supposed economic stability, not during a global emergency like the pandemic. This marks what can be identified as Stage 2, exponential acceleration. Where does this leave us today? Interest payments on the national debt have now surpassed $1 trillion annually, more than the entire military budget and the second largest government expense after Social Security. According to projections by the Congressional Budget Office, interest payments are expected to reach $1.8 trillion annually by 2035, with a cumulative total of $13.8 trillion over the next decade. For context, the previous decade saw just $4 trillion spent on interest. This represents a staggering 350% jump. By fiscal year 2026, interest payments will consume over 15% of federal revenue, meaning that more than 15 cents on every tax dollar collected will go solely towards servicing debt, not reducing or paying it down, just covering interest. Another alarming development is the Federal Reserve's balance sheet, which has surged from under $1 trillion in 2008 to over $8 trillion today through direct money creation. This digital currency printing is effectively modern-day debasement. When compared against historical instances, such as Roman silver debasement, the parallels in trajectory are grimly identical. The pattern of decay is unfolding in eerily similar fashion. The smartest financial players have taken notice and are beginning to act. In late December 2025, institutional investors orchestrated what's now being referred to as the Great Rebalancing, moving over $1 trillion in assets over 2 weeks. Heavyweights like BlackRock, Vanguard, State Street, and CalPERS, arguably the most cautious and methodical asset managers globally, shifted enormous sums into more defensive portfolios. They have started offloading shares of high-performing tech giants like Nvidia, Microsoft, Apple, and Amazon, the companies driving recent market rallies. Not because these firms are struggling, their fundamentals are still sound, and they lead in growth metrics and balance sheet strength. But this isn't about underperformance, it's about rebalancing and de-risking portfolios. When equity-heavy portfolios spike in value as they have recently, they require reallocation to maintain balance. Hence, asset managers move back into bonds and other defensive positions. However, these moves signal something deeper. These institutions could have chosen to ride the wave of market growth or adjust their allocation strategies to maintain momentum like retail investors tend to do. They didn't. Instead, they deliberately shifted investments to safeguard against anticipated turmoil. Vanguard has gone so far as to signal a shift in its investment outlook. U.S. equities are overvalued at dangerously high levels. Bonds now offer competitive returns at lower risk, and international stocks are likely to outperform American equities over the next decade. This isn't traditional investment advice. It's a warning signal. It speaks to fundamental instability. Consider the data. A once reliable 40-60 portfolio, 40% equities, 60% bonds, now has an expected return of 5.7% over 10 years, compared with only 5.3% for a risker 60-40 split. The volatility difference is stark, 6.9% for the safer allocation versus 9.3% for the higher risk one. The implication? The risk-reward calculus for equities has broken down entirely. This leads directly into stage 3, the crisis phase, the point where system instability becomes unmanageable and monetary debasement accelerates irreversibly. The government is now locked into a cycle it cannot escape. The $38 trillion national debt demands perpetual refinancing. Annual interest payments of $1 trillion must be made. No former Treasury Secretary Janet Yellen just issued a stark warning. The U.S. is approaching fiscal dominance. That's the point where debt becomes so large that the Federal Reserve loses its ability to control inflation. The Fed can't raise rates to fight inflation because higher rates make the debt unpayable. They're trapped. The interest payments become an injection of money into the economy that fuels more inflation, creating a feedback loop. When Paul Volcker crushed inflation in the early 80s by raising rates to 20%, the national debt was only 25% of GDP. He had room to operate. Time for fiscal adjustment. Today, the debt is 120% of GDP. The impact of rate hikes is instantaneous. The government can't afford higher rates. The Fed has lost control. At some point, and nobody knows exactly when, confidence breaks. The world starts questioning whether the dollar will maintain purchasing power. Foreign central banks reduce treasury holdings. Demand for dollars weakens. The currency begins losing value faster. The Fed faces an impossible choice. Raise rates to defend the currency, which crashes the economy and makes debt service impossible, or keep rates low and let inflation surge, which destroys purchasing power and trust. Either path leads to crisis. Either path completes the pattern. Stage 4 becomes inevitable. And when that moment comes, the assets that hold real value will surge. Land, commodities, gold, productive businesses, because the dollars themselves will be worth less, much less, potentially worthless, if the pattern completes fully. Those positioned in real assets will survive. Those holding government promises and dollar-denominated bonds will watch their wealth evaporate, just like Roman citizens holding debased denarii, just like German pensioners holding marks, just like everyone throughout history who trusted government promises over economic reality. The pattern is playing out in real time. Stage 3 accelerating towards stage 4. The timeline is unknown, but the destination is certain. Let me address the 3 things the experts will tell you. The 3 arguments they'll use to dismiss this analysis. This time is different. No, it's not. Every failing system believes it's different. Rome thought their empire was eternal, unshakable, the greatest civilization in human history. It collapsed. Weimar Germany thought their modern industrial economy could absorb the shock. It couldn't. Medieval princes thought they were clever enough to get away with debasement. They weren't. The United States thinks its reserve currency status, its military power, its technological dominance make it immune to the pattern. They don't. They just make the eventual adjustment more violent, more catastrophic, more complete. Technology will save us. No, it won't. Technology doesn't change mathematics. Productivity improvements don't change the fact that you cannot spend more than you earn indefinitely. AI won't solve fiscal insolvency. Digital currencies don't eliminate the temptation to debase. The printing press didn't save Weimar Germany, even though it was advanced technology for its time. The Roman Empire had the ancient world's most advanced engineering roads, aqueducts, concrete that we still can't fully replicate today. Technology didn't save them. The Kipper and Whipper crisis happened during a period of significant monetary innovation. Technology has never stopped this pattern ever. American exceptionalism makes us different. No, it doesn't. Every empire believes it's exceptional, right? Up until the moment it's not. Rome was exceptional for 8 centuries. Then it wasn't. Spain was exceptional when it controlled New World silver. Then it wasn't. Britain was exceptional when the sun never set on its empire. Then it wasn't. American economic dominance is not a law of nature. It's a historical circumstance created by specific conditions following World War II. Those conditions are changing. The dominance is fading. The exceptionalism is an illusion maintained by people who refuse to study history. So what can you do? You cannot stop the pattern. You cannot change government policy. You cannot fix the fiscal trajectory. But you can position yourself to survive it. Understand the difference between real assets and financial promises. Real assets have value independent of government promises. Land produces food regardless of what happens to the dollar. Commodities have industrial uses that don't disappear. Gold cannot be created from nothing, no matter how many dollars the Fed prints. Productive businesses generate cash flow in any currency. Financial promises, bonds, currency, government securities are only valuable if the government maintains its ability and willingness to honor them. History shows that ability and willingness eventually fail. Always. Without exception to follow the smart money. Vanguard isn't recommending 40/60 because they're pessimistic. They're recommending it because they understand risk, because they see valuations, because they know what institutions are doing behind the scenes. When the largest, most conservative asset managers in the world start positioning defensively, that's not a suggestion. That's a warning. That's a signal. That's your cue to pay attention. Diversify internationally. The United States is deep in stage 3. Other economies are at different stages, different points in the cycle. Diversifying internationally means you're not betting everything on one government's fiscal responsibility. Vanguard's own projections show international stocks outperforming U.S. stocks over the next decade. That's not anti-American sentiment. That's mathematical analysis of valuations and growth potential. Maintain liquidity, but not in long-duration assets. You need cash for opportunities and emergencies. But that cash should not be locked in 30-year Treasury bonds if those bonds will lose purchasing power. Short-term treasuries, money market funds, assets. You can move quickly when conditions change, when the pattern accelerates, when stage 4 approaches. Educate yourself on monetary history. This video is one data point. Read about Roman currency debasement. Study the Weimar hyperinflation. Understand the Kipper and Whipper crisis. Learn what happened in Zimbabwe, Venezuela, Argentina, Turkey, Lebanon. The pattern repeats because human nature doesn't change. Government incentives don't change. The mathematics of debt and debasement don't change. The trillion-dollar rebalancing isn't about year-end portfolio housekeeping. It's about institutional recognition that we are entering a new phase, a more dangerous phase, the phase where the pattern accelerates toward its inevitable conclusion. The Roman Empire took centuries to collapse. The process was slow, then sudden. For generations, everything seemed fine. The economy grew. The military won victories. The debasement was gradual, barely noticeable until suddenly it wasn't. Until the currency collapsed completely within a single decade. Weimar Germany took years, not centuries. The mark lost value steadily, then catastrophically. 1 million marks, 1 billion marks, 1 trillion marks for a loaf of bread. It seemed impossible. It seemed insane. But the mathematics were simple. The government needed money it didn't have. So it printed and printed and printed until printing became physically impossible because they ran out of paper. We are not at that end point. Not yet. We're not in stage 4, but we are deep in stage 3. The pattern is unfolding. The smart money recognizes it. They're positioning for it. They're moving $1 trillion to prove it. The question is not whether the pattern will complete. History is absolute on this point. The question is, what will you do with this information? Will you dismiss it as doom and gloom? Will you trust that this time is different? Will you believe the experts who say everything is fine? Or will you look at the data, study the history, understand the pattern, and position yourself accordingly? The institutions are moving. The smart money is rotating. The signals are everywhere for those willing to see them. Your move Don't just watch this unfold. Subscribe to this channel for the next video, where I break down exactly which assets survive systemic debasement and which get obliterated. The historical data is clear. The pattern is absolute. What's coming next will determine your financial survival. Hit subscribe. Turn on notifications. Share this with anyone who needs to understand what's happening beneath the surface. Because the pattern doesn't stop. The mechanism doesn't pause and time is running.